Welcome back to another Bond Outlook's educational video, and today we are discussing buying the rumor and selling the fact. Now, buying the rumor, selling the fact, what is it? It is a slang saying in the market that is utilized to highlight market participants capitalizing on market movements before they occur. Participants will open a position based on a rumor that is bubbling in the market. Now, this could be based on a political change of hands, a bad print that is speculated to hit the market, or even an interest rate alteration, something that is rumored that is going to happen soon and the market is positioning before it actually occurs. Now, the point of this is traders are positioning based on an announcement they're anticipating, which could shift the market in their favor. This generates and coins the terms priced in prior to a data release that has largely been expected. Traders have already been buying the rumor, price has already moved, and then you hear the term, well, it was priced in, and of course the inverse happens on the print. Now, knowing when the market is buying a rumor can explain a large phase of appreciation or depreciation prior to an announcement. So, buying the rumor. Now, it's speculation on expected news in essence. Traders anticipate that an upcoming event or announcement will have a positive or negative impact on a currency's value. This could be anything from a central bank decision, economic data release, political events, or any significant news that can affect currency markets. Now, early positioning, what is this? It's based on a trader's expectation. They will buy or, of course, sell a currency before the event even occurs. Traders may buy the dollar before NFP or sell the dollar before NFP. Why? Because they're buying the rumor that the data is going to come out good or bad for that currency. Now, why do they do this? It's because they are aiming to profit from the movement. They anticipate it will happen once the news is out, and the idea is to get ahead of the market before the reaction actually occurs. Now, after the rumor has been bought, that brings us on to selling the fact. So what is this? Now, before we read this, you often see data prints come out very good for an economy. You could see the unemployment levels drop down. You could see GDP print positive, yet the currency reacts the opposite way. The currency will weaken on a good print or strengthen on a bad print. Well, why is that? Well, it's because the rumor has been bought and then the fact is sold. Buying the rumor, selling the fact. So let's speak about the selling the fact side of it. Now, looking at the points here, it is adjusting position post-announcement. Now, once the anticipated event occurs and the information is public, the market reacts and currency values adjust to reflect the data. Now, at this point, the fact is known to everybody, but the fact was already likely traded into price and already bought and priced into the market. This is known as being baked in or priced in. Now, realizing your profit or losses. Now, traders then sell their position or buy it back if they're short to realize their profit or limit losses. This is because often the market has already priced in the expectation to a large extent, and the actual news might not come as a surprise and might not move the market any further. Or it might even, in the opposite direction, move price as the news was not expected. We call this a wrong footing. So what is the positives of spotting this? Now, adjusting positions post-announcement is absolutely key. Once the anticipated event occurs and the information is public, the market, of course, reacts and the currency value adjusts accordingly. Now, at this point, the fact is known to everybody, and if you believe this is reflected within the price, you utilize the new inbound of flow and inbound of market participants to take profit off the table. And this brings me on to the second point of realizing your profits or losses. Traders then sell their position or buy it back if they're short to realize those profits. This is because often the market has already priced this in. Now, what's the downsides of buying the rumor and selling the fact? Well, first of all, market volatility. This strategy or this approach to markets can contribute to increased volatility around the time of the announcement, as many traders may be basically positioning prior to the print. The second reason is self-fulfilling prophecy. Sometimes the collective action of traders buying a rumor can itself move the market, making the anticipated reaction a self-fulfilling prophecy. In other words, traders were just bidding this currency up or selling the currency off based on the rumor, off the expectation, and they're only doing this because of their belief, their expectations. Now, finally, and the most important one is the risk. It's a risky strategy because it's based on speculation and expectations. If the actual news differs significantly from what was expected, or if the market had already fully priced in this rumor, traders might find themselves on the wrong side of the trade and heavily reversed on. Just like we said, How many times have you seen a very good NFP print or a very good GDP print, yet the currency weakens? Huh? How does that make sense? Well, that's the thing. If it was fully priced into the rumor, then the market will do the opposite. It will buy, of course, it will sell the fact. So it buys the rumor and it sells the fact. Now let's look at an example. As you can see, the market is evidently selling euro dollar off. We sell off from about 112.5 all the way down to around about the 105 handle. Now, in theory, we were still downtrending pretty aggressively. But as you can see, we had a big leg up from about the 106.5 handle all the way to the 108.5 handle. What happened there, I wonder? Now, the market was caught offside. We saw a missing NFP. We saw a dovish Fed. Euro dollar rallied because the market was wrong-footed and it was stung on buying the rumor. Now, how do we know this? Two reasons. The COP data showed us that the market was net short this, closing out that week. And ultimately, you can see from the price action how much short momentum was coming in here, how many sellers were entering the market. So this is an example of where buying the rumor actually got you stung, okay? So that is buying the rumor and selling the fact. It's been a pleasure to present it to you. Let's jump to the next session.